Great. Okay, so good morning, everyone. Welcome to the latest BCIS Outlook for Construction webinar. So just a bit of housekeeping as per usual. So apologies for those who attend regularly and hear me repeat myself, but I'm Richard McLean. I'm the Chief Commercial Officer at BCIS. Joining us today, as per usual, is our Chief Economist, Dr. David Crosswaite. Hello, David.
Good morning, all.
So just a bit of housekeeping before we start. As usual, the webinar is being recorded and it will be shared with everyone who registered. It will also be accessible on our website. So if you want to stay up to date with the latest news and insights from BCIS, please do follow our company page on LinkedIn. We've already had a number of questions submitted prior to the webinar, so which we'll try to answer during the session. But of course, we do welcome your questions from the attendees as we go along too. This is accessible just by the little question mark symbol that you've got on the icon bar. Any that we don't get time, we will do our best to cover these during the session, and we'll send out a follow-up in the Q&A recording. So we do try our hardest to cover every question either in the session, or if not, we'll pick it up afterwards.
Yeah, they also might be too difficult for me to answer, Rich. So
they're the ones that I'm going to prioritise that we try in the session.
Decent.
And then the easy ones we'll save for afterwards. So also, likewise, some poll questions will pop up during the webinar itself. They can be accessed if you just click the little graph icon on the bar. So the purpose of these questions is just for us to understand what you are seeing in your role. These can also help us think about future content that might be useful also. And to allow the questions to be answered right up to the end of the session, we won't publish the answers during this webinar, but we will share the full results with the recording. So following the session, you'll also receive a short survey asking you for some feedback on the webinar itself. We just ask honestly, please, could you just spare a few moments to complete the survey if you can? It really helps us plan future sessions and the content that we publish as well, and also understand how we can help you going forward. So there's also an option to ask questions that you didn't get a chance to ask during the webinar. A lot of people kind of think of extra ones after the session, so feel free to pop them through and we shall try and cover everything you send over. So our panel today is short and sweet. So yeah, as I said, myself, Rich McLean, Chief Commercial Officer at BCIS, and joining me is Dr. David Crosswaite, our Chief Economist. So without further ado, David, I will pass over to yourself.
Okay, thanks, Rich. Hopefully, most of you on the call are aware of the agenda and the format of the outlook. Essentially, we're going to look at what the prospects for construction are over the remainder of this year, and also on a 5-year time horizon, which is always slightly iffy, I think, given the climate that we're currently in. But don't hold that against us. So to address that question, we'll look at the current outlook and we'll look at future demand levels and our predictions for those, any cost and price movement in our sector, and then we'll look at some industry views, so people at the coalface, draw some conclusions, and as Rich said, we'll then take your questions, which hopefully won't be too challenging.
Please do. Yeah, the more challenging,
there's certainly a lot of questions probably to be posed, given.
I think you might be right. Yeah.
So if we quickly set the scene, and actually quite a lot has changed since the last outlook. I mean, probably the main thing is the recent spending review, which finally brought some really positive news for the construction sector, with what looks like significant levels of capital spending on built assets, not only over the life of this parliament, but actually over the next decade. And the hope is that the government spending plans will encourage the private sector to invest more in construction. You've probably heard a lot about Rachel Reeves trying to encourage institutional investors, and that's predominantly pension funds, to start investing in infrastructure. So that will, watch this space, but that will be a big boost for our sector. But however, there have been challenges. Both domestic and international headwinds are negatively impacting confidence. We can almost see that changing on a daily basis. And that's leading to increasing uncertainty about the future, which also makes our job as forecasters quite challenging. The other thing to consider is that we've got ongoing labour capacity issues. Pretty much everyone knows that. My view is that our labour capacity issues are probably actually constraining demand to a certain extent. And that's why we haven't really seen it increase over the last few years. So there's no guarantee that proposed projects will be delivered on schedule, on budget, or even at all. So it seems at the moment that we sort of take one step forward and two steps back, and that's given the recent events in the Middle East, certainly hasn't helped there. So we move on to the next slide. We'll examine the current outlook for construction, and we used a combination of both BCIS and ONS data to do that. So if we look at construction output, that's total output, which is the top line, then new work, the blue line, and repair and maintenance output is the green line at the bottom. And actually, construction's outperforming the wider economy for the first time in a while. So the recent ONS data shows monthly construction output was up by 0.9% in April, and that's the latest data we have. While GDP, gross domestic product, shrank by 0.3%, which is great news. New work output was the main driver of that growth, with surprisingly public non-housing output exhibiting the highest growth levels on a sector basis. This is really good news for our sector, which, as you can see in the chart, it's seen total output stagnate for the better part of 2 years, and new work output, which is obviously the largest sector of work, has declined significantly over that period. And given the positive spending review, we're forecasting construction output growth to pick up slightly this year, and then we expect significant recovery and growth accelerating from next year onwards. And most of that growth we're predicting will come from new work output. Well, we expect repair and maintenance output growth, which has been the main driver of growth really since the pandemic. We expect that to be more subdued over the next 5 years. If we move on to the next slide, please. So now we'll take a look at new work output. We'll break that down by subsector. And the top line, the blue line, is private housing output, and the sort of yellowy orange line is infrastructure. And then we've got private commercial under that. The other three subsectors is significantly smaller. In new work, the private housing subsector, which is the largest, as you can see by volume, has returned to growth after seeing some significant falls in output since it reached its peak in 2022. We're forecasting steady growth in output for this year before growth really accelerates from next year onwards. And this is largely as pent-up demand. We're expecting to feed through to house price growth, which will encourage developers to start building again. Also, the recent modest base rate cuts are expected to continue this year, although I think given recent events, I suspect there won't be quite as many as we thought at our last forecast. I think we baked in 3 rate cuts last time, and now we're expecting there to be only 2 the remainder of this year. So that should improve housing affordability going forward. But having said that, we're not expecting private new housing output to reach its peak, its 2022 peak, until 2028. That actually is slightly more positive than last time. We predicted 2029 last time, so that is slightly more encouraging and positive for housing. The next sector of note is infrastructure. and that had been declining since 2023 after reaching historical highs. However, recent government announcements, and there have been numerous, including the new infrastructure strategy, we're forecasting output growth in infrastructure to return this year, and it will continue through the remainder of the forecast period. And largely that's output's going to be maintained at a relatively high level as work is buoyed by energy, air transport and water sectors, and also continuing work on major projects such as HS2 and Hinkley Point C, and obviously along with offshore wind projects in the electricity subsector. Having said that, future output levels in infrastructure are going to be conditional on the content of the project pipeline, which we're still waiting for, and obviously the availability of private finance for schemes such as Lower Thames Crossing, the HS2 Euston link. So yeah, there are still some unknowns, and surprisingly in the infrastructure strategy there remain some unknowns in terms of what funding mechanisms the government are going to adopt for securing private finance. Obviously, also we've got Heathrow and Gatwick Airport expansions, which are going to feed through into infrastructure output going forward. Although when that's likely to happen, we're not yet sure. So we're also predicting output in both the commercial and industrial sectors to remain relatively flat, with only marginal growth evident over the next 5 years. And the current state of the public finances also puts much public spending at risk, and we're not expecting growth in public housing or non-housing really over the forecast period. So overall, we're predicting total new work output to grow by 18% over the next 5 years, which is about the same as our previous forecast last quarter, slightly higher. If we move on to the next slide, please, and we'll look at repair and maintenance output. And you can see that after a period of really significant growth, repair and maintenance output has started to fall as cost of living and public finance pressures are persisting. Public housing repair and maintenance remains subdued over the entire forecast period. Really, that's the line at the bottom, with virtually no growth. But the much larger public non-housing repair and maintenance sector shows a decline in output from its peak earlier this year, although we are predicting a recovery in 2026, followed by some growth through the remainder of the forecast. And this is largely because the government have indicated that they're going to increase maintenance budgets going forward. I'm not entirely sure how they're going to realise the cash for that, but they have pledged that that's what they will be doing, and to tackle some of the backlogs in maintenance spending that hasn't happened really over the last better part of a decade. Also, through 2025, we're predicting a return to growth for private housing repair and maintenance before output falls again through next year. And then it sort of cycles pretty much through the remainder of the forecast. Overall, we're expecting total repair and maintenance output to grow by 11%. So as you can see, significantly lower than the 18% for new work. But that is slightly more than our previous forecast, and that's based on the government's commitment to spend on renewals. Having said that, it should be noted that public spending is likely to remain constrained throughout the entire forecast period, and will likely impact output growth in public housing, public non-housing, and also infrastructure repair and maintenance. The current economic uncertainty and the difficulties with financing is pushing asset owners into postponing routine maintenance, which will likely lead to increased costs to maintain the public estate in the long run. So these postponement of cyclical maintenance is obviously a real issue, I think, in the public estate, and has been for some time. Okay, if we move on to the next slide, which is, so we've looked at output, now have a quick look at the ONS series for construction new orders. Last time, if you remember, this was fairly pessimistic, actually. The orders data was down. But according to the latest ONS data, total construction new orders increased by 27% in the first quarter of this year, compared to the fourth quarter of last year, with £11.6 billion worth of new orders placed. And on an annual basis, that represented an increase in orders of 11% on the same quarter of the previous year. Infrastructure orders saw the strongest growth, and they more than doubled the orders that were recorded at the end of last year. And private industrial orders also showed some strong growth on the previous quarter. However, private housing, probably the biggest losers, new orders were down 7% on the previous quarter, and down by 17% on an annual basis. This sort of highlights suggests the target of 1.5 million new homes to be delivered over this Parliament might present even more of a challenge than we'd already been anticipating. It's hard to see how current order volumes are going to translate into new home completions at the scale that's required for the government to reach their target. Currently, I think we're looking at sort of 200,000 new home completions annually, and what the government needs to hit. Developers need to hit 300,000 to get close to the government's target. So there is still a significant shortfall in new housing provision. Okay, if we move on to the next slide. So the orders picture is certainly much more positive than it was last time. And if we have a look at the summary of growth predictions on an annual basis, so this is sort of short-term growth prospects, and hopefully some of you may recognise the chart. It hasn't changed from last time. And the short-term outlook is reasonably positive, but the long-term outlook is even more positive. So, but there is always a caveat. The state of the public finances, combined with the still relatively unfavourable investment climate, because interest rates aren't falling as quickly as we expected, that is continuing to negatively impact output in some subsectors. But having said that, there are some bright spots that we've already seen. And we've got growth expectations in new housing, infrastructure, and housing repair and maintenance output over the next year. But the growth in the other subsectors is expected to be largely flat through the remainder of this year. But the prospects going forward appear to be significantly brighter than they have been for some time, which is good, because I was being branded a pessimist. Okay,
uncharacteristically positive, David.
Well, it's good to finally have some good news to report.
It really is, yeah, absolutely.
So we move on to the next slide. We'll now take a look at costs and prices, and essentially we're going to look at the current inflationary drivers for construction using our data. And first off, we'll take a look at the all-in tender price index and the general building cost index. And quarterly growth in tender prices, as measured by the BCIS all-in TPI, increased by 0.5% in the second quarter of this year. And that was the same increase as the previous quarter, resulting in annual growth of 2.3%. And you can see from the chart that growth in tender prices has been slowing, and we're not expecting it to pick up until the end of next year, with growth remaining relatively flat throughout the forecast period. But having said that, I think a lot of this is going to be conditional on demand, and this is one of the reasons that we're desperate to see the government's project pipeline, to see when projects are going to be released to the market, their funding mechanisms, their budget allocations, so we can have an idea of demand and capacity, and whether they're going to be pinch points. So once we've seen that, I think we'll probably have a better view of what future tender prices might look like. They look pretty benign at the moment, based on current data, but that may well change once we get view of the pipeline, of the future pipeline going forward. Building costs, as measured by the BCIS General Building Cost Index, increased by 0.4% in the second quarter of this year, which resulted in annual growth of 3.5%. So similar to the last quarter, inflation in our sector continues to be driven by increasing labour costs rather than material cost increases, and most of that, certainly a lot of it, is being driven by the impacts of the changes to employers' national insurance and the minimum wage, and those impacts have been felt over the last quarter and probably will be for the next quarter. Overall costs are predicted to rise by 14% over the forecast period, with labour costs remaining the main driver into next year. But as you can see, cost growth certainly stabilises midway through next year, and it looks fairly benign going forward through to 2030. Okay, we move on to the next one. We'll take a look at BCIS input cost indices, and this is a slightly different chart. We've got another index series on here from last time, so we've included plant costs as well. So we've got materials, labour, and plant, obviously the three main inputs to our construction prices. So muted growth in materials cost inflation continued into the second quarter of this year. The BCIS materials cost index is forecast to grow by just 0.3% on the previous quarter and by 1% on an annual basis. We expect materials costs to maintain their upward trajectory through to the end of next year before they stabilise at around 3% growth through the rest of the forecast period. Overall, we're predicting material costs will grow by 13% over the forecast period, so through to the second quarter of 2030. The BCIS labour cost index increased by 2.5% in the second quarter of 2025 in comparison with the first quarter, which is obviously a fairly big jump, and that resulted in 7.1% annual growth in labour costs. And as we've touched on, that increase was largely a result of the uplift to employers' NIC and the national living wage. We're forecasting labour costs to grow by 16% over the forecast period through end of second quarter 2030. So 13% for material costs over that period and 16% for labour costs. So you can see that labour costs are still the main inflation driver. And similar to our previous call forecast, the risks do remain on the upside as skill shortages are still prevalent in the market, and will likely continue to constrain future demand levels unless they're addressed. And that's a challenge not only for the government but also for our industry. And as I said, we've got a new series on this chart. So we've included plant costs. Plant costs have really, as you can see, exhibited some dramatic swings in the recent past, but some stability appears to be returning. BCIS plant cost index is estimated to increase by 0.8% in the second quarter of this year, and that resulted in an annual decline actually in plant costs of 2.3%. We're predicting that plant costs will grow by 14% over the forecast period through to the second quarter of 2030. Okay, we move on to the next slide. So as usual, we'll also take a look at growth in construction earnings, and we've plotted that against consumer price index just so you can see the variance between general inflation and construction earnings inflation. So construction wages, as measured by the ONS's average weekly earnings data set, increased by 6.4% in the year to first quarter 2025, and that's the latest data we have. And although on a quarterly basis, the rate of increase appears to be slowing, wage growth in construction is still running at above inflation levels. But we do expect some stability in wage growth going forward. But having said that, much is going to depend on any inflationary impacts. And we're still waiting to see the fallout from what's been happening in the Middle East, and whether or not the Straits of Hormuz are shut down, which will obviously have an impact on the oil price going forward. But fingers crossed that doesn't happen. So yeah, earnings growth is still running well above wider inflation in our economy. Next slide. We'll then quick look at market conditions index, and basically the market conditions index shows the relationship between costs and prices, and it's currently forecast to decline by 1.4% in the second quarter of 25 compared to the previous quarter, which results in a fall of 1.1% overall when compared with a year earlier. And as I always say, when the market conditions index is rising, prices are rising faster than costs, and when it's falling, costs are rising faster than prices. So we're still seeing, as we've seen in previous slides, we're still seeing costs rise marginally faster than prices. And given what we've seen on the input cost side, we're not likely to see tender prices lead costs until next year, when some recovery in prices is likely. But as I said, I think a lot of this is going to be down to the demand that's going to be highlighted in the project pipeline, hopefully, once we eventually see that. So moving on to industry views, and one of the reasons for including this is that data is all well and good, but there's only so much that data can tell you, especially when considering the lag in producing that data. So we now take a look at some of the comments made by members of our industry panel at the latest meeting, which was a couple of weeks ago. So sort of prior to the Iranian problems. Yeah, so this should give us an understanding of what's happening on the ground. So this slide, we're looking at procurement and trades in particular. So one of the comments was, whilst contractors are eager to tender, the number of dropouts during the tender stage has increased, and bidders want more information up front before making decisions to tender, to essentially better understand the project risks, and that's particularly around delivery timetables. Also, single stage procurement has more dynamic pricing, and as such has tightened up a bit in the last quarter. On the trade front, our panel members were seeing keen pricing across demolition, piling, and concrete packages. And something we've touched on already, general labour shortages remain concerning. And the M&E premium continues. Now, in Scotland, I think the M&E premium has diminished, but certainly down here it seems to be fairly persistent. And given the high demand and limited availability of some key equipment and labour in particularly high-tech markets such as data centres, and the peak period for M&E work at Hinkley Point C, that's sort of driving some of the capacity issues in the M&E area. We go on to the next slide, please, Rich. Take a look at sectors to see which ones are experiencing growth or decline. And first up, new build housing is suffering from delays due to Gateway 2 preparation and applications for high-risk building approval. This there is only one comment there, but this came up multiple times from our panel members, and this is something that the government really need to address fairly quickly, I think. The backlog for Gateway 2 approval is huge in terms of numbers of projects. It's in the hundreds, with only sort of a handful having already been approved. And you know, further problems down the line are going to be the Gateway 3 approvals and sign off. And this is really having a major impact in terms of high-rise resi development. So in terms of other key sectors, asset upgrade and decarbonisation projects, we're doing well, as well as commercial fit out. And this is, the commercial fit out was interesting. It's largely been driven by the technology and legal sectors, and I think probably include banking in that as well, pushing the return to the office agenda. So certainly, I was in London last week, and it certainly looks a lot busier than it has been. So I think a lot of businesses are now back in the office, and obviously that's driving the commercial fit out sector. Another comment: MEP and fit out are hot markets at the moment. Data centers are still strong, but investment in defence is gathering pace, as we've heard from the government over the last month. Education and sports, leisure and hospitality also strong, but does depend on where you are in the UK, as most things do. The other interesting comment was projects that can move forward with greater certainty, and that's largely sub 18-metre residential developments, or those that are less than 7 stories, are getting a good price, and that wasn't the only comment in terms of sub 18 metres. Quite a few panel members were noticing that developers were actually deliberately going in sub 18 metres to avoid having to go through the gateway process, which I thought was a fascinating insight, that developers would actually, so they could start building, would actually go in under that height restriction to avoid the approval process. So it really is something that the government needs to look at fairly quickly, particularly if they're going to get anywhere near their 1.5 million new home target. Okay, if we move on to the next slide, please, Rich. And a couple of comments on project size and logistics. Project size, and I think looking at this actually only recently, the number of tier 1 and in relation to private finance, there remains some capacity constraints in the large project market, because I think the lack of tier 1s, and given that main contractors are trying to push up their OHP. So we've got a sort of almost perfect storm brewing. We've got not that many tier 1s, but a whole raft of large projects coming to market potentially through the project pipeline, which suggests to me that domestic contractors are probably going to lose out, and the international contractors will be taking up a lot of the forthcoming work. But anyway, that's something we'll have to keep an eye on. So smaller projects that can be procured on a single stage basis, and also offer a quick start and relatively low pre-construction resource commitments, are offering some opportunities to the more nimble integrated contractors, and they're attracting more competitive bids. Finally, if we move on to logistics, so one person, one panel member, no logistical challenges at present. The market is relatively quiet. Another picked up insolvencies within the construction sector, particularly among mechanical and electrical subbies, which is posing significant risk to project delivery and cost stability. And heard this on a number of occasions, and not just from panel members, but currently we're in a wait and see scenario, and I think given that we're almost seeing things change on a, if not weekly, but if not daily, but weekly basis. There's high levels of uncertainty about current global trading conditions, which means that many investors and developers are putting projects on hold until the situation improves. And another reason to really get the project pipeline into the public domain as quickly as possible. I'm not sure why we've got to wait for it until the middle of July. I'm assuming it must already be produced, but anyway, it's another story. Having taken all that in, we can move on to the next slide and summarise what we've examined today in terms of output and orders, costs and prices, and sort of industry comments. And we can move on to addressing our question. What's the outlook? So we've got output increasing and predicted to grow this year before really accelerating next year. Orders are increasing, which should boost the future pipeline. Building costs are increasing, largely driven by uplifts in labour costs. Tender price growth is stagnating, but the question is for how long? If demand really picks up, I suspect we'll see tender price growth feeding through quite quickly. Material costs are increasing, albeit relatively slowly, and labour cost increases have picked up, obviously, as the impact of the national insurance and national living wage uplifts have fed through, but they are expected to slow through the remainder of this year. And finally, plant costs are on the rise, but from a relatively low base. So if we come to a conclusion, what next for our industry? I think everything we've looked at today suggests that the picture's changed significantly since the start of the year, and indeed since our last outlook. Things appear much more positive, although some concerns remain largely around the capacity of the industry to respond to that increasing demand. The spending review and subsequent infrastructure strategy were broadly positive, with really significant levels of investment in built assets announced, and that's something we haven't seen for a number of years, which is all really good news. However, there are some serious challenges that remain, and not least is how to attract private finance or private investment to fund these future projects. And I don't want to labour this point, but we really do need to see sight of the project pipeline to allow the sector to plan for delivery. And without that, we are sort of flying in the dark, really. But broadly, I'm very positive, which, as regulars of this webinar will know, is a fairly unusual position for me.
Brilliant. No, thanks, David. And all jokes aside, it is incredible to think even where we were 12 months ago. It's an absolute day and night change, isn't it?
Yeah, it is. I mean, yeah, we have to be careful because a lot of this is rhetoric. A lot of it is talking. And while I am generally positive, we haven't really seen a lot of action.
No.
And this is one of the reasons why I want to see the pipeline, because until I see that, I'm not entirely convinced that what they've announced is going to actually translate into reality. So.
Good, right, there he is.
A return to type, yeah.
Excellent. Great. Well, thanks, David. So what we'll do is now we'll move on to some of the pre-submitted questions. Just a reminder for everyone, if you have got any questions you want to pop into the Q&A section, we'll try and tackle them. And just a polite reminder, if you haven't had a chance to complete the polls yet as well, it'd be great if you could just spare a moment. As I say, it really does help us. So as I said, we'll pop on some of the pre-prepared questions and we'll see how we're getting on. So great. So David, yeah, with the growing adoption of AI and machine learning, how do you see these technologies reshaping construction cost forecasting in the next 5 years?
Well, I definitely think they will complement rather than challenge traditional index-based methods. AI, artificial intelligence, and machine learning essentially could be used to gather data that feeds indices, and indexes are just a way of presenting data. So I don't think that index approach will change, but the source of the data that feeds the index might well change. And you know, we're as a business, we're currently looking at this, and I suspect a lot of other organisations are too. I saw a piece about the Big Four having been influenced by artificial intelligence. They're now not recruiting as many graduates as they used to, because some of the tasks that those graduates used to undertake can now be done or delivered by AI. So I'm wondering, and this is a massive leap of faith here, but I'm wondering if actually industries where artificial intelligence and machine learning won't have that big an impact, and I'm thinking here of construction trades, might become more attractive. And as I said, it's a fairly big leap of faith. But if you imagine sort of service-based industries, I think artificial intelligence is going to have a massive impact, and not just on the things that our business does, but also in construction generally. So, you know, particularly in traditional roles like quantity surveying, where I can imagine that AI will have a fairly big impact. So I'm wondering, you know, if trades might start to look slightly more attractive. I think it's going to be a long time before robotics and off-site manufacture start to impact trade stuff. I mean, we have been talking about that for decades, but it's never actually materialized. So yeah, trades might be a safer option than working in an office, which is a complete reversal of fortune.
Quite the statement, that I think. It is interesting. I'd actually read the same article about the grads being replaced with AI, but
yeah,
what do you think the impacts? Because naturally, those grads previously progressed on to more senior roles. Then you know that's a serious consideration for how you progress your talent, right?
Absolutely, yeah. I mean, I'm wondering how much thought has really gone into this. I think the AI piece is so immature at the moment, and people aren't really sure of what the impacts are going to be long term, or what the benefits are, to be frank. But it does, you know, at first sight, it does seem to me to be a major change in the way that work will be delivered going forward. And you know, you've only got to look at Terminator to realise that we could all be in trouble. So.
Right, that snippet will be on the BCIS website by next week. Brilliant. Okay, so on to the next question then. So and actually I've had this quite a few times from clients, but how is BCIS planning to adapt its forecasting models to better capture the impact of emerging geopolitical shocks, things such as conflicts, trade disruptions that cause sudden volatile changes in construction costs?
I should have stated first up before I started answering these answers are my answers and not necessarily BCIS's answers. I mean, yeah, I mean, going back 10 years, I'd have said that there was no need to capture shocks in real time within the modelling process, as you know, frankly, nothing much changed on a quarterly basis. So it was actually quite difficult to model things that it's just stayed flat. However, I mean, given recent events, things seem to be changing on an almost daily basis, and obviously some of those things will have an impact on the cost of construction. Our forecasts are currently updated quarterly when we take into account changes that have happened since the previous forecast, including any shocks. And I guess my question is, how frequently would subscribers want updated forecasts? I mean, most forecasters produce their outputs quarterly, and to be frank, I'm not really sure of the utility of a forecast in real time, as it would be constantly changing. So if you were using it for benchmarking or valuations or whatever, in terms of our cost and price indices, etc., then I mean, do you really want those to be produced in real time? They'll be changing almost on an hourly basis. But yeah, I mean, it's an interesting question, and obviously, I suspect it's going to gather more credence as the AI and machine learning piece gathers steam.
Great, no, thank you. Yeah. Okay, and I think we've got. Oh, wow. Sorry, I hadn't read this one before. Right, okay. I'm just going to remind you, we've only got 14 minutes left, David. So, how would you evaluate the government's first year in office? And again, just to repeat, this is David's view, and not BCIS.
I'm assuming there's no Labour Party members on the call. I mean, I think it's been a difficult first year for the government, with both domestic and international crises. Like I've said before, it's a lot easier being in opposition than it is being in government, without question. In summary, I think a lot of rhetoric, a lot of documents produced, a lot of plans, but not a great deal of action, really. The last month, we've seen a slew of announcements that should have a real positive effect on construction, if they all materialise, and I think it is a massive if. My suspicion is that the investment that's been announced over a 10-year period will actually probably be spent over two decades. I just don't think there's a capacity in our sector to deliver these grandiose plans. And the other, certainly from a construction perspective, where is the project pipeline? Why have we had to wait a year for the project pipeline? I fully understand that they had to get their feet under the table, get an understanding of what was needed, but for that to have taken a year, to me, seems frankly unbelievable. The spending review is good news for our sector, with significant levels of investment in built assets. But now comes the difficult bit. We've just got to finance and build these projects, and therein lies the real problem. And the chart you've just put up sort of summarised the new house building problem. So this essentially shows you the net additional dwellings in the first year of the Labour government, and essentially we haven't even hit the previous year's target, which was only around 200,000. And the government needs to deliver. Well, the developers need to be building 300,000 new homes a year for them to get anywhere close to that target. So fundamentally, they're not going to do it. I mean, I've heard lots of rumours about Starmer always knew it was going to be an impossible target and has set Angela Rayner up, and knowing full well that she'd be unable to deliver it. So, so that's just what I've heard. It's probably completely untrue, but I do like a bit of gossip. So yeah, in summary, I think it's been a difficult year, but as the old saying goes, things can only get better. That was the last Labour government, wasn't it?
Well, yeah. Lovely. Okay, great. And then the final prepared one. So the government said it will only consider public-private partnerships in project and sectors where this is a revenue stream, where appropriate risk transfer can be achieved and where value for money for taxpayers can be secured. Do you see any risks with this approach?
I mean, I think on the face of it, that approach seems sensible, given the lessons from the past with private finance. But the risk is that the projects don't get funded and therefore don't get built.
That's the problem.
Or are, end up being prohibitively expensive, with future generations left to pick up the bill. I mean, interestingly, the infrastructure strategy, which sort of covers a lot of the funding mechanisms for private schemes, as well, was a little bit light on detail regarding potential public-private partnerships. It sort of kicked the can down the road and said that a final decision will be made at the autumn budget in October. There's really not a lot in the strategy document that we haven't heard before. The government have said that they'll explore ways of encouraging private investment by getting pension funds to invest in infrastructure. Consider the use of the regulated asset-based model, the RAM model in its acronym, for the Lower Thames crossing and also Sizewell C. And that model was used successfully on the Thames Tideway tunnel. And they'll try to encourage other private investment that essentially will try and avoid all the pitfalls of the previous PFI and PPP schemes. They've said that they're looking at using PPP on the HS2 Euston link and also some social infrastructure projects. But the three criteria, the guaranteed revenue stream, risk transfer, and value for money, I think seem quite stringent, and I suspect that they'll probably get watered down. But the proof will be in the project pipeline once released, and whether the government can secure. I mean, this is a big issue, I think, for me, and I'm not sure whether the government has really thought this through. Will the government be able to secure enough bidders for projects to ensure competitive tension? And that competitive tension is vital to ensure value for money. And that really was one of the major criticisms of past private finance schemes. So if you look at the market for these projects, and depending on their size, and they're going to be considerable in the multiples of billions of pounds, to raise that level of finance, you're really looking at a quite small pool of delivery consortiums, going to be funders, equity houses, contractors, probably. Quite a small pool of domestic suppliers, which I suspect will encourage international bidders to come in, and frankly, they're probably the ones who are going to be most suited to this work going forward. But there are some significant risks, I think.
Yeah.
But having said that, without the private finance, we're not going to be building much. So.
That's the problem, right?
Yeah, therein lies the problem.
Yeah. Brilliant. Okay, great. Well, we've got a few moments left, so I'll try and pick up a couple of questions just before we wrap up. We've had a few through. So what I think these were when we were going through the output slides, but so how do you see the shortage in labour, skilled, unskilled and professional, affecting your new work output predictions?
We've sort of factored that the capacity of the industry probably won't increase in the short run, but it should increase in the medium to longer term as the new training and apprenticeship initiatives start feeding through. But I think the realization is going to have to occur to the government that they're going to need to encourage overseas workers back to UK construction. So we have taken that into account.
Great, lovely. And also slight nuance on that as well, but also had a question with regards to the output slides. Does this include PBSA? So I'm presuming that's purpose-built student accommodation.
Sorry, what was the question?
The output slides, which sector does PBSA fit into?
Student accommodation.
Yeah.
I would imagine it would fit into private commercial. So yeah, most of these things, a bit like all resi, is delivered by. I would imagine, yeah. I'll check, but I would have thought it would be private.
Brilliant. Great. Okay, but just while I'm scanning through for a few more, just a final polite reminder, if you could jump on the polls for us, that would be great. Most of them are already complete. There's one last one to complete, so greatly appreciated. So the next question, David, was when we were doing the panel views, and so what the question was is, what do you mean by dynamism in one-stage procurement? What signs are you seeing of this?
Go back to the slide. I can't remember. My memory's not that good anymore. Dynamic pricing. Single stage procurement has more dynamic pricing. Yeah, so basically pricing is not static. So likelihood is that it's going to be fluctuating. So probably upwards. Yeah. Yeah.
Cool. Great. And then next question is, are there any notable regional variants in demand, cost pressure or growth outlook? And they're particularly asking for areas like the East Midlands or the Southwest.
Yeah, I mean, obviously, a lot of demand is in London and the Southeast. And one of the government's stated aims is to, well, not only this government, but the previous government too, is to try and level up. But the reality is that construction demand tends to coalesce around population. So where you have high levels of population, you tend to need a lot of buildings and a lot of infrastructure. So I don't see that position changing radically. I think London and the South East will still be the drivers of construction output going forward.
Yeah,
certainly in my lifetime.
Definitely. Great. Actually, so only two more now. So we're nearly there. I think we'll wrap up perfectly this month, or this quarter even. So actually, a question we get a lot with a number of clients as well. But is investment in data centers growing as much as other countries, do you think?
I probably can't comment on that because I'm not sure what the picture looks like overseas. I think one of the blockers obviously has been planning here, and my suspicion is that they probably don't have those sort of blockers internationally, certainly not to the extent that we have. So I do appreciate the government trying to push things through on the planning front, and yeah, the data centers are probably one of those areas that have suffered in the past, but hopefully going forward we can catch up.
Great, lovely. Oh, actually, sorry, I lied. We've just had a few more sneak in, so we've still got some time. So in your view, could this public-private partnership be used for trying to plug the gap in the new housing output forecast to hit the 300,000, do you think?
No. No, because essentially the government are using PPPs to build infrastructure projects, and not just economic infrastructure projects, but social infrastructure, but because they haven't got any money themselves. Because the likelihood is that PPPs are going to be more expensive than if the government were paying cash. So it's for infrastructure projects that are sponsored, that are public sponsored projects. Housing is not public sponsored. Housing is delivered by private developers. Private developers have no problem getting hold of cash to build. They just need a booming housing market, low interest rates, and control of supply to maintain their price levels. So no, PPP is not applicable to housing.
Great. Well, lovely. I think that's probably wrapped us up perfectly. So yeah, thank you for everyone for joining. Just to repeat as well, if there's any questions you think of afterwards, you'll get the chance when we send out the information. But yeah, David, thank you very much, and thank you everyone for joining.